is Chin Simin. Together with me is Siti Noor Shahira, Komati, and Higneshwaram. We will present about the difference between saving and investments in terms of risk associates, challenges, and perception. Saving is the unused balance keeping in the account. The advantage including low requirement to register an account, high liquidity, eligible protection by PIDM, 24 hours availability, and accessible to withdraw or deposit money. However, the disadvantage including low interest rate that could not cover the inflation. Due to the convenience of online banking with tag code, this increased the criminal activities by scammers. Investment is an asset to help people to achieve short-term or long-term financial goals. People can generate profit by sell at higher price and use the potential earned to cover the inflation rate. Investors can invest according to their preference, needs, and priorities. Furthermore, people could have minority ownership by holding various organization stock. The disadvantage including possibility of losing money and low liquidity in cash. It is also time-consuming and knowledge required to analyze the investment option to minimize risk. Therefore, saving is accumulating money for future use with no risk, whereas investment is leveraging money for a potential future gain with different risk levels.
Saving in hand. When we were a child, our parents bought us piggy bank and taught us to save money by putting aside whatever balance we had from the daily allowance. That is a starter for us to create habits in saving money. Saving in hand, usually in a small amount and not intended to be kept for long term. There is a huge risk to keep a big amount of money in hand, so it is advisable to save money in bank, which is more secured. Saving money in bank is the most commonly used method to save money. The easiest way to do is by salary deduction directly to bank. Also, some banks like Maybank has functioned in their internet banking to create goal saving plan. Saving money in bank should not be for a long term. It should be to accumulate reserves in the saving account to be used in the short term, or for emergency fund, or for planned payment that we want to make in the year, such as to renew road tax or car insurance. This is due to saving money in bank could not beat the inflation. The longer we hold the money in saving account, the value of money will be depleted as the return is very low or insignificant. Tabung Haji provides Sharia compliant saving and administers investment transactions to add value to their depositors. Saving in Tabung Haji is one of the best fixed investment methods as the capital is guaranteed, but at the same time, the depositors will get annual dividend. Many Muslims register Tabung Haji account to save money with the main intention to go to Hajj when their turn has come. However, this saving method can also be for a long term as it gives good return which varies in the range of 4.5 to 6% throughout the years. The advantages of saving in Tabung Haji is that the zakat has been paid for the overall saving. It means that the return declared has net 2.5% zakat. So if we are to quantify or evaluate the return from the saving, we should take into account the 2.5% that paid for zakat as part of return. Then we can compare it with the other investment method.
Hi, I'm Komati and I'm going to talk about the fixed deposit investment. There are two types of fixed deposit investment. One is a bank fixed deposit and the other one is a corporate fixed deposit. Bank fixed deposit have lower rate of return and lowest risk compared to the corporate fixed deposit. There are multiple risks associated with this investment. The first one will be a liquidity risk. It is possible for a bank fixed deposit to withdraw the money before the maturity date. However, in corporate fixed deposit, it's impossible to withdraw the money before the maturity date. Second one will be default risk. The capital and the interest payment in corporate fixed deposits are not secured and can lead to the investors to lose their entire capital in this investment. However, for bank in fixed deposit, they have lower default risk and the capital and interest payments are secured up to a certain level. We will look into the inflation risk of this investment. When the inflation gets higher, the real rate of return of this fixed deposit will get lower. In addition, there is a reinvestment risk in this investment. When the maturity period ends and the investor plans to reinvest his money, there is high chances that they could not get the earlier interest rate that was higher than current. Looking into the perception of fixed deposits and investments, it is widely known and also very popular among public. It is because they don't have knowledge about other investments that are available and also risk aversion that they have.
The next part is about mutual fund. Mutual fund is one type of investment that form out by pool of money from many investors and managed by a fund manager. Mutual fund consists of different types of risks, including market risk, concentration risk, interest rate risk, and liquidity risk. The current challenges for mutual fund in Malaysia are related with market risk and liquidity risk. According to the fund manager sharing in media, the political issue may lead to an elections when COVID-19 conditions are controllable. This could cause the pandemic to be more serious and burden the medical system. When the political issue and pandemic that raise the market risk, this negatively impact to economic and unemployment rate increase. Then, this lead to liquidity risk when people lost their job and no extra cash for investment. So, fund manager will have limited sources to buy security and generate low returns of fund. The perceptions of mutual fund is people can save time and no professional financial knowledge required on the fund. Mutual fund is depending on the fund performance and the security value hold. This indicates that the returns will change according market condition. Hence, the more volatile the fund, the higher the risk of the investment. We have few examples of mutual funds including ASMB, PRS, or public mutual fund.
Hello, hi, I'm Ignesh. I would like to introduce another product of investment, which is stock. Stock is actually a fractional amount of the asset in a company from their shares. So in share, there are three main market capital. There's a large market capital, medium or small market capital. In large, it's usually a bit more stable, but medium and small is a bit higher in risk, but then the growth potential is a bit higher. So when we go into detailings, there are few more details before we analyze the stock. So there are growth versus the value stock. So growth stocks are usually higher in the PE ratio because investors trust that the growth potential of these stocks are much higher compared to the market. For example, Roku, another new media streaming company, have much higher PE ratio compared to Netflix, the market leader in the industry. Next, we go into value. So value stocks are lower than the market ratio, or it's quite equivalent to that. So that investors believe that the growth potential of it will gradually grow in a longer period of time. Next, we go into yield and non-yield type of stock. So there are relatively nowadays there's a lot of companies are giving dividends for investors. This is an additional income, but not necessary that this is an essential criteria. Even the largest company in the world like Google, Facebook, and Tesla are not paying any dividends, but yet they are being trusted by investors. Next, we move into the blue chip stocks and penny stocks. So blue chip stocks are one of the market leaders. They are very stable. They are even in inflation. They do not immediately slump their prices, like Johnson & Johnson, Walt Disney. So all of these companies are market leaders and they are stable. Penny stocks are bought by investors for quick trading, whereby they buy a dip and quickly sell it upfront to gain quick profits, and then they use that money again to reinvest and continuously gain profit. So all in all, it's very important to have diversification in your portfolio so that you manage the risk accordingly. So that is important for a good investment strategy. Thank you.
Overall perception of bonds, it is not well known or popular as stocks or shares, but it could be a safer investment. The reason why it is not popular is because of its lower rate of return compared to other investments, and also the higher requirement for investments. This risk will be the interest rate risk. The interest rate is inversely related to the bond price. The higher the interest rate, the lower the bond price. This is because when the interest rate in market goes up, the investors will try to sell off the bonds that they hold with lower interest rate, making the bond prices to go down. There's also a reinvestment risk in bonds. When an investor tries to reinvest the money into another bond, there is a high risk that they could not get the higher interest rate that they get on an earlier bond. Any other investments, bonds also face inflation risk. When the inflation goes up, it is possible for bonds to get negative rate of return. Then bonds are subject to credit risk. Bonds are purchased with trusting the company's ability to pay up the debt. So it is important for the investors to investigate the background of the company, the cash flows, and also the operating expenses of the company to understand if the company is worth investing or not. Lastly, we will look into the liquidity risk of the bond. With low number of participants in the market for bond, the investors could not sell a bond promptly. They will have to sell it at a lower price if they have urgency.
Hi, another investment product I would like to introduce would be cryptocurrency. This is a new product that is very popular nowadays. You can see one of the largest or the earliest cryptocurrency, Bitcoin, has started from $0.008 to $67,000 over the period of years, and this is an accelerated growth potential that any companies have never seen before. But then it's highly risky. Every single day we could see 2 to 3 figures of dip and down. So then it is very important to understand the underlying operation behind cryptocurrency. Cryptocurrency is a decentralized system. This is why a lot of analysts have already commented that this is maybe a risky operation. So then always firm up your plan, formulate your plan, and understand the underlying cryptocurrency digital operation before formulating an investment. Thank you.
Investment in gold, either in gold account or physical gold, is not liquid and take very long time to get good return. There is high risk of theft or misplaced if to keep the huge amount of physical gold in the house. So some people may opt to keep their gold in fixed deposit, and this has holding costs. As gold is a commodity, even historically the price shown an increase trending, but it is not guaranteed it will always increase. It is hard to predict the percentage or increase as the price fluctuates. It is hard to predict the percentage of increase as the price fluctuates depending on the demand and supply, same as the other commodity investment like crude oil, palm oil, and tin. Gold investment or other commodity investment is good to retain the value of money in the long term as it fights inflation, but to expect a very high return, it is not guaranteed. Nowadays, with many gold accounts offered by the financial institution, gold investment is made easier for people to invest. This can be among the options for investors to diversify their investment.